Good morning, everyone. Very good morning. How are you all, my dear students? Again, a Monday morning. A very interesting topic we are going to cover up today, which is about the security valuation. Right? Good morning. Good morning. Good morning, Anila. Good morning, Mamta. Sahil, Stephen, Nisha, Nilay. Okay. Good morning. Good morning. Okay. So today is going to be a really interesting day for all of us because we'll be starting with a very interesting topic, which is security valuation, right? Uh, have you ever heard of this term valuation, guys? Ever heard of this term valuation? Yep. Have you heard any time of this term valuation? Something in some, some shows or somewhere in the newspaper articles, you might have heard this word valuation. So that valuation term is basically it's a process, right? It's a process to determine value of anything, right? So it can be value of any asset, it can be value of any liability also. So in this topic, we are primarily focusing ourselves on security valuation. Now, before we go into what is security valuation, how security valuation is undertaken, let's just be, clear about why do we need to undertake valuation. Yeah. So any reason that you can identify that why do we need to determine the value of any asset or liability, guys? What would be the reason that we want to value anything? Let's say we want to value a share or we want to value a debenture, or for that case, we want to undertake a value of a company. Why do we really want to know or calculate the value of any asset? What could be the reason for that? What could be the reason for undertaking valuation of a company? Why would you like to get your asset valued or liability valued? Right? So let's say I want to undertake a valuation of a company. So what could be the reason? Okay, to for purchase or sale, to take a loan. Okay. Like let me just put it in a more simpler way. Let's say uh, one share of, let's say, MBD Limited. There is some company is trading in the market at a price of, let's say, 27 rupees. 27 rupees is the price of the share. Are you going to buy this share or not? Will you buy this share at a price of 27? Are you going to undertake the valuation of, are you going to buy the share at price of 27? Some random company having a market value of, let's say, 27 per share. Will you buy the share or no? So we can't decide whether to buy or not, right? We can't decide just on the basis of the market price. So what stops you from taking a decision? What stops you from taking the decision to buy or not to buy this share, or to invest or not to invest in this share? Because we don't know the value of it, right? So can I say, before I take any decision regarding buying any share or selling any share, what I need to know is the value of the same, right? So value can be defined in different ways. You can say it is intrinsic value or fair value. So generally, we are talking about the intrinsic or the fair value of a security. So if you are able to determine intrinsic value or fair value of a share, that will help you to take a decision whether we should buy this share or whether we should not buy the share. Am I right, guys? So suppose if I tell you that based on the valuation techniques, which we are going to cover in today's and also upcoming sessions for the valuation. So let's say the fair value of share, I'm saying that it is 25 rupees. The fair value of the share or the intrinsic value of the share is, let's say, 25 rupees. So what are we going to do? Are we going to buy this share or are we not going to buy this share? Yeah. Tell me guys, if the fair value of the share is 25, the intrinsic value of the share is 25 and it is available in the market at a price of 27. Will you buy this share or no? Will you buy this share or no? Of course, no, right? Because the price seems to be more than what it should be, right? If I want to just connect it with a different example, let's say you go to the market, right, and you find that you want to buy, let's say, potatoes. So 1 kg of potato is available at a price of, let's say, 1,000 rupees. Are you going to buy potato from that vendor? Are you going to buy potato from that vendor? 1 kg of potato is, the vendor is quoting you 1,000 rupees. Now, right now, considering the current prevailing conditions, okay, considering the current prevailing conditions, are you going to buy this potato for 1,000 rupees a kg? Good morning, Oja, Ginny. Yeah, are you going to buy this potato for 1,000 rupees? Of course, no, because we know that it is not worth that much as of now. I mean, prevailing conditions doesn't require us to give 1,000 rupees for 1 kg of potato, right? So the decision regarding whether buying a asset or not buying a asset, it actually depends on intrinsic value or fair value of a product, right? And then you take a call whether to buy out, right? So, for example, uh, current market price of, let's say, HUL shares. Its current market price of HUL shares is, let's say, for example, 3,540. Okay, just an example. So if it is 3,540, current market price of HUL shares is 3,540. Then you undertake the valuation using the valuation techniques that we are going to learn in today's class and also in the subsequent classes. You arrive at a intrinsic value, intrinsic or fair value. You arrive at an intrinsic or fair value of, let's say, 4,600. Now, what is your decision going to be? Whether are you going to buy the shares or you are not going to buy the shares? We will buy, right? Because we are seeing a value proposition over here. The share which is worth, let's say, 4,600, if it is currently available in the market at 3,540, it means, of course, this is something a good deal for us and we should go ahead for buying this share. Am I right, guys? So the idea is, before you do investment in anything, before you do investment in anything like any shares or any debentures, any real estate or any sort of asset, you need to know what is the value of it based on some fundamental principles. Based on some fundamental principles, we need to know what is the value of this particular asset, and then you are going to take a call whether to buy or not, right? So if I want to put up a simple rule for discussion, uh, if the value of asset, right? So we are talking of the fair value of the asset. If the fair value of asset is greater than market price, so what will be your decision in that case? If the fair value of asset is more than market price, are you going to buy the asset or you are not going to buy the asset? If the fair value of the asset is more than the market price. See, market price is something that you will observe in the market due to the demand and supply forces. Due to the changes, changes in the market price will happen due to the demand and supply. But our idea is not to get flowed away with the demand and supply pressure. We should be in a position to, take a informed decision regarding its valuation. So fair value of asset, if it is greater than market price, so what will be the decision? Are we going to buy the asset or are we not going to buy the asset? Yes, fair value is more than the market price. It means you are getting the price at a lower price in the market. So value of the share in the market is lower as compared to what it should be. So of course, it's a value investing. It's a value stock for us, and we should definitely buy that. Of course, our decision is going to, buy the asset, because we know that today the market price is lower. Like in our example, today the market price is 3540, but as per our estimate, as per our calculations, it should be worth 4600. So we observe that the market price is likely to rise by another, let's say, 1060 rupees. So of course, we should invest in this security. So if your fair value of asset is going to be greater than market price, we are going to buy the asset. Okay. And the opposite applies. If we have the fair value of asset, lesser than the market price, then we are going to, if we have the shares, we will sell the asset rather. Correct? So if your fair value is lesser, I mean, in the market, the stock is trading at a higher value, right? So then you're going to sell the asset for a simple reason. Like we are going to buy the asset in first case. Tell me, in the first case, like when the fair value of the asset is greater than market price, is the asset overvalued or undervalued? Is the asset overvalued or undervalued? Tell me, is the asset overvalued or undervalued? In the market, can I say it is undervalued or it is underrated right now? There's a lot of potential in the company shares, right? So buy the asset because asset is undervalued. And in the second case, we are going to sell the asset because asset is overvalued. Correct? So the decision rule is simple. If any asset is undervalued, we are going to invest in. We are going to buy the asset. If any asset is overvalued, then we are going to sell the asset because we are getting better than what it should be. I mean, we are getting a price which is better than what the price should be. Correct, guys? Right, guys? Yeah. Okay. Now, yeah. So now we are looking at the roadmap of this typical chapter that we are going to cover.
Jagbanduji, some students are also responding on the query handle also.
Yeah, I'm just looking at that, sir.
Yeah, please also take.
Yeah, I'm just looking at that. Undervalued, yeah, they're answering the same. Yeah. Okay, students. Yeah, so let's look at the roadmap of this particular chapter. This chapter we are going to divide primarily into two sections, guys. One is regarding the valuation of equity, that is equity shares, and the other is regarding the valuation of the bonds or the debentures. Okay, so the roadmap that we are going to set out in this chapter. First, we are going to discuss about the return concepts. What do we mean by the return? Like something we are going to discuss about required return. You might be knowing something called as internal rate of return, right? Some sort of equity return, debenture return, then required return on equity. So all those aspects are going to be covered in this broad area. What are the return concepts? Second thing that we are going to do is about valuation of equity shares. Now again, in the valuation of equity shares, we are going to cover few subtopics, like we are going to cover something called as dividend based models. I'm pretty sure you might be aware of the term called as Gordon's model. Am I right, guys? We've learned about this in inter. Gordon's model. Yes. Gordon model is something that you might have learned. We are going to discuss that in more detail. Okay. So that is going to be based on dividends. Not only Gordon, you might have learned something called as Walter model also. So that Walter model is also going to be discussed in this particular chapter with more detailing things. After dividend-based decisions, then we are going to look at some of the different methods called as earning-based model. Okay. And the next point that we have here is cash flow-based model. Okay. Now see, valuation cannot be, a sacrosanct number which will be arrived at equally by all the valuations. I mean, everyone who undertakes the valuation is definitely going to get a different value. It's never going to be a case, that the value is same or exact, point by point, it is same for everyone. Like if I calculate the value, it might be different. If you calculate the value, it might be somewhat different. But what we are looking at, a range of fair value and acceptable range of values which we want to assign for the shares or debentures of any entity. Okay, so because it's all based on certain models, and that models are subject to some sort of assumption, some sort of inputs that may vary, right? So you cannot say that if I arrive at the value based on dividend, based on earnings, and then based on cash flow, I am intending or I'm likely to get the same value every time. No, that's not going to be the case because it's going to be different for different approaches. But our idea is to get values from different perspective, from different methods, and then try to maybe remove those very absurd values together, and more or less an average value can be determined. This I'm talking from a very practical point of view. When we really undertake the valuation of companies, there we calculate the values from different angles and then arrive at a weighted average value to assign for any deal, right? So you might be aware of M&A deals or startup funding. So there obviously valuation undertakes. There obviously valuation is undertaken, and before that, I mean that valuation is followed by different methods. Okay, so that's the second part that we're going to discuss about the valuation of equity shares using these three different approaches. Okay. And one more thing we have here is something called as enterprise value. Now, this is something that it's a new thing that we're going to learn, something called as enterprise value. EV is a very widely used term nowadays in the corporate world to determine the valuation of equity shares from a different perspective altogether, right? And then we have the next topic, which is valuation of preference shares, right? Followed by valuation of bonds. Okay. Now, valuation of bonds or debentures, of course, it will require an understanding of the time value of money, taking the present value and all such aspects. But we are also going to learn some new terms over here. We will be also trying to measure the risk that we face in a bond by way of certain topics, like first would be obviously getting determining the value of the bond. Also, we are going to discuss what do we mean by bond duration. Now, duration means we're talking of Macaulay duration, and also something called as modified duration. This is really going to be an interesting part and studying this Macaulay and modified duration, because I'll try to visualize this as much as possible to you have a visual effect of what is happening with the prices of the bond. Okay. So this is the broad area that we are going to cover. And not to forget, obviously, the fifth part would be regarding the valuation of warrants, talking about the convertible debentures, then talking about whether the bond should be continued or it should be refunded early, some money market instruments, right? So we're going to discuss something about money market instruments, some treasury bill valuation. So these are all smaller topics that we are going to have at the end. But the major portion is what we are going to cover as we see over here. Now, today's session, we are going to be focusing on the equity valuation. Today, as well as the next session, is going to be discussion about the equity valuation. Now, before that, let's understand the return concept. Now, in that, first thing that we are going to discuss is First thing that we are going to discuss is about calculation of required rate of return. Required rate of return. Okay. We as an investor, uh, before we make an investment, can I say there is always something in our mind. There is always something based on our opportunity cost or based on the cost of funds that we are investing. We need to have some sort of required rate of return. I mean, we need some amount of return from a particular asset to arrive at its value. We need some sort of return, some amount of return that we will be setting it as a benchmark that we need this much return. That's your required rate of return, right? Now, of course, your required rate of return, is it going to be constant for all the types of securities, guys? Yeah. Do you think that the required rate of return is going to be constant for all the types of securities? No. Then how are you going to determine what is your required rate of return from a particular concept, from a particular asset? Yeah. Obviously, you will require some rate of return based on the risk that a particular security has, right? So you will take into account what is your opportunity cost of capital, and also you will take into account what is the risk in the security, right? So required rate of return uh, is basically the rate of return that an investor is expected to receive, right? This is also called as opportunity cost of capital. This is called as opportunity cost, right? Opportunity cost of capital, because you're going to invest your money into a particular asset, and of course there is some cost which you have incurring before you're making an investment, right? So that's your opportunity cost of capital. Or when you want to invest in any particular asset, you're going to forego some return from your other assets, and that's what you need over here, right? Then there is something called as discount rate. Now, discount rate is simply the rate at which you're going to calculate the present value of future cash flows. So it is the rate used to calculate present value of future cash flows. Discount rate is the rate that is used to calculate the present value of future cash flows. Now, this rate is of course not going to be same for all the types of assets. Okay, it is not going to be the same for all the types of assets. It is going to be, you know, depending on the risk of particular asset also, right? So it also going to be depending on the risk of particular asset. So it depends on risk of asset. Not only the risk of the asset, in fact, we should say it depends on the risk of cash flows. It depends on the risk of cash flow. Okay, can you tell me if suppose we have, uh, let's say, year and cash flow. So year 1, 2, 3. So let's say we have got 3 years of a project or 3 years for cash flows that we're expecting from a particular security. So let's say 10 rupees, 12 rupees, and then 15 rupees. Is it mandatory that I use the same rate of discounting? Is it going to be like same rate of discounting applicable to all the three cash flows? Can I use the same rate of, is it mandatory that if it is 10%, I should discount all these cash flows by 10%? No, you cannot, it's not mandatory for you to discount all the cash flows using single rate. It's not at all mandatory, because you can obviously assign different discount rates for each of these cash flows depending on the risk that you have in the security. Am I right, guys? So if one of the cash flows is less risky, then you can obviously assign a lower rate for that. And if one of the cash flows is having a greater risk, then you can obviously assign a higher rate of return that you expect from that cash flow. Okay. Uh, Karthik, as I have basic here regarding these types of financial, like one of them, never able to under what constitutes the value of a security. For say, if you look at any company, like, we know that there are so many elements, engine, body part, these are creates a value for the product. We are able to ascertain what is included in the what is actually included in the value of securities. Well, let me come to the point, Karthik. We'll discuss how do we determine the value, right? Because I think in the previous chapter also we discussed value is basically something that you will assign value to any asset if you're expecting future cash flows or future benefits from it in the future, right? So simple fundamental of finance since ages it has been established. It's always value of any asset or anything is always going to be uh, present value of all your future cash flows. It's always going to be present value of future cash flows. Now the challenge here lies is how to get the rate at which you're going to discount it and what should be your future cash flows, right? And we are just engrossing ourselves with those concepts. We are just trying to go through the process of obtaining the present value of future cash flows. One is now we are discussing about what should be the discounting rate, and going ahead, we'll discuss about the future cash flows that we expect from a security also. Okay. Okay. So let's come back, guys. So year one, two, three, we say cash flows. If there are different cash flows, we are likely to assign in practical life also, I'm telling you guys, we are likely to assign different discount rates for different cash flows depending on the risk that is involved in the cash flow. Now, from the basic understanding from these three cash flows, can you tell me which cash flow is having, as per you, lesser risk? Is it year one cash flow? Is it year two cash flow? Or is it year three cash flow? Which cash flow do you think is more is going to be less risky? Year one, because something which you can foresee in near term is supposed to be more certain and it's going to be obviously less risky, right, guys? So can I say suppose the discount rate, if I say 10% will say it is more certain. I know what is going, we can forecast with easily with greater degree of certainty that this 10 cash flow is going to be certain, or I can say it has got a greater degree of certainty. So you may discount this at maybe, let's say, 8%, right? Then the second year cash flow may not be that certain. So you may go ahead and discount it at a bit higher rate, maybe 9%. Third year cash flow, maybe it is even more uncertain, so you may discount it at a higher rate. Okay. So it is possible that depending on the risk of the cash flow, what should be the discount rate that we should apply, right? So we have this cash flows, the discount rate. Now, of course, if I want to calculate the present value, I just need to multiply it with the present value factor. Can you guys tell me what's the present value factor at 8% or 1 year? What will be the present value factor at 8% for 1 year? Yep. Can I say 1 divided by 1.08? So that's 1 divided by 1.08. That's 0.95, right? Then what about the discount rate for 2 years? What about the discount rate for 2 years? So 1 divided by 1.09 to the power of 2. So we can say it's 0.84168. And if it is 10%, we'll say 1 divided by 1.11 to the power of 3. That's 0.7311, right? So present value will be cash flows multiplied by PV factor, and then we just take a total of it, right? So this particular asset should be having a value of 30.33. Are we getting it, guys? This particular asset is having a present value of 30.33. Considering the cash flows, are discounted at different rates. The value of this asset is 30.33, right? So these are the cash flows which is applicable for each of those years, right? So I need to discount this full cash flow at 11% for 3 years. Okay, fine. So there are obviously different approaches to this idea, but the point is that we can discount each cash flows at different rate of return also. Now the next concept is about internal rate of return. Can you tell me what is a simple understanding that you have regarding internal rate of return or IRR? We might have already learned this in foundation lecture, in not in foundation, but in at CA interlevel. So what's the internal rate of return? Okay, one of the properties of internal rate of return is that there you get the NPV as zero. But what do you mean by internal rate of return? So internal rate of return is basically the rate of return earned by investor, right? Earned by an investor. It's a rate of return which is earned by the investor from an asset, right? For example, if I ask you, let's say investment amount. Let's say you are investing 1,000 rupees in a security, and sale price, you are selling the security for, let's say, rupees 1,200, right? In year one. What is your rate of return that you have earned? What's the rate of return that we have earned? Tell me, if you're investing 1,000, what's the rate of return that you have earned? So can I say a simple way of understanding IRR is nothing but the rate of return that we are earning over here. The rate of return that you have earned is 20%. And this 20% is nothing but, sir, IRR. This is a very simple where you are investing it for just 1 year. So when you sophisticate it for a higher number of years, that's the same thing which we are talking of. Okay. Okay. One thing that you're saying, discounting rate, it should be like the PV factor, whether it should be 1.08 into 1.09 for the second year. Like some of you are asking whether for the second year it should be 12 rupees divided discounted for 9% for 1 year, and then for again for 8%. No, we are not saying that, because when we are talking of year two cash flow, the second year cash flows are more uncertain. So for the entire 2 years, they will be discounted at 9%, right? But if it is a different approach, we will discuss about that in a later stage, probably in the upcoming topics where we use that partial thing. Okay. So as of now, we are taking that this entire 12 rupees is having a risk, and therefore we are fully discounting it at 9%. Okay. So how did you get 20%? It's simple. Investment 100, sale price is 1,200. So 200 is your income. So that 200 divided by your initial investment, that's your 20% rate of return. And that itself will be your IRR. Like if you want to check the NPV at 20%, you can just write down year, cash flows, PV factor, and then PV. So like in year zero, you're investing 1,000. PV factor is 1. And of course, PV will be 1,000. Then in year one, you're receiving a cash flow of 1,200. So PV factor at 20% will be 1 divided by 1.2. Now, if you multiply this 1,200 with 0.833, what you observe is an IRR of, or sorry, is an NPV of 0. Got it? So it's a simple explanation of understanding why your NPV will become 0 when you're using discounting rate as 20% for the IRR. Okay, perfect, guys. Now, after this, we are going to look at the equity return, or the required return on equity. Have you guys heard something called as capital asset pricing model? Do you remember something called as capital asset pricing model, guys? So where did you learn this capital asset pricing model? At CA interlevel, you have learned this capital asset pricing model, right? Correct? Yes, risk-free rate plus the risk premium you might have heard. Yes, based on risk-free bond plus risk premium. Perfect. Correct, guys. So that same thing is what we are looking at over here. I'm pretty sure you might have learned this concept called as capital asset pricing model. The cost of equity will be determined as risk-free rate plus beta multiplied by RM minus RF. Correct, guys? Have you heard of this? Yes. Okay. My question to you is, what is this RF? What is this RF? Yes, guys. What is this RF? Risk-free rate. And what do you mean by risk-free rate? What do you mean by risk-free rate? Government bonds, that is certain. Okay. So we're talking of RF is essentially the risk-free rate of return that we are likely to get, which is 100% sure, right? So which we generally say that it is the government bonds or the government securities, correct? That's true. So RF over here is the risk-free rate of return, right? RF is basically the risk-free rate of return, uh, which is generally rate of return earned from government securities. Okay. Now, tell me what is RM? What is RM? What is the term RM over here? What do you mean by this term RM? Yes. Risk premium, no. Return, market return, market rate of return. Okay. RM is basically rate of return on market portfolio of securities. To make you understand it in a better way, I can say that RM is basically the rate of return which you get from maybe a market index. We know what is Sensex, correct, guys? Are we aware something called as Sensex? Are we aware something called as Nifty? Right. So these are the indices, which are the broad market indices, which indicate that overall a portfolio, a bunch of securities, how are they moving, right? How are they moving together? What is the movement that is happening in the overall market? So we see that, BSE Sensex have reached 85,000, right? So it's likely to come up to 1 lakh. So that's the BSE Sensex, which is an index number, just like an index number, right? With base being some past year, maybe 1990s, right? So that index, the rate of return that you get from that index is representing the return that you're getting on an average from the entire equity market. So that's your BSE Sensex or your Nifty, which is the RM, right? So let's say past year Nifty had some starting value. Now it has some value. So the rise in the Nifty value, when you express it in percentage form, that will be your RM. And the same goes for Sensex value also. Okay. So that's the rate of return on the market portfolio. Okay. Okay. What do you mean by beta now? What do you understand by beta? We'll discuss more about this beta, uh, in the chapter of portfolio management later. But right now, just to have a very, very primitive or a very prima facie idea about what is beta. Beta is basically a measure of systematic risk. It's a measure of systematic, simply a measure of systematic risk. Now, what do you mean by systematic risk? It essentially means that the rate of sensitivity, okay, systematic risk is basically rate of sensitivity in security as compared to market portfolio. Like, for example, if I tell you, let's say if beta is 2, if beta is 2, what does this imply? If we have a beta of 2, it simply means that security is twice as risky as market. So if beta is 2, security is twice as risky as market. It also means one thing, that if market changes by 1%, or you can say if market return changes by 1%, security return, okay, so if market changes by 1%, we say that security return changes by 2%. So it's like it's a sensitivity. It is your security is twice as sensitive as the market as a whole, right? So if your security is having double risk as compared to the market, so the risk premium that you get, what do you mean by this RM minus RF? Can you say RM minus RF is what? It's the risk premium of the market. Overall market, what's the extra return or the risk premium that you're getting? That's your RM minus RF. And when you're multiplying it with beta, you're adjusting the risk premium. You're adjusting the risk premium in relation to the security return. You're adjusting the risk premium in relation to the current security. Like if your security is, double risk as compared to market, what is the amount of risk premium that you will need? What is the amount of risk premium that you will need? If your security is double risky that of market, do you expect a more risk premium or a lesser risk premium? Of course, we want a more risk premium, and that is going to be the risk premium is also going to be double of that, right? Therefore, beta is added as a multiplier over here to this RM minus RF, and then you add, of course, the bare minimum rate of return that you need. So this portion, if I just try to put it up over here, this RM minus RF is risk premium of market. This is risk premium of market, correct? And then we include beta along with RM minus RF. This becomes risk premium of security. This becomes the risk premium of the security, guys, right? And then, of course, we need a bare minimum risk-free return also. And therefore, we say that K is derived in this particular line. Okay, so I just tried to quickly revise what is CAPM because we'll need it. More detailing about CAPM, how this beta is calculated and all, we are going to discuss it, possibly in the chapter of portfolio management there. Okay. Now, we have already learned something called as nominal and real cash flow. So I'm not going to discuss much on that part because we already know nominal cash flows are going to be discounted at a nominal rate of return, and real cash flows are going to be discounted at a real rate of. Now, let me go ahead with valuation of shares. We'll do some concept and then we'll go for the questions. Valuation of equity shares. How many approaches did I tell you at the start of the lecture we are going to have for valuation of equity shares? Broadly, how many ways are we going to value the shares? One is based on dividend, the other is based on earnings, then the third one is based on cash flows, right? And of course, we have the enterprise value method also. So valuation of equity shares right now, let's begin with two things. One is the dividend-based model and other is the earnings-based model. Dividend-based model and earnings-based model. Okay. So first one is dividend-based model. Okay. In that also, first type of model that we are going to say is if holding period is 1 year. So let's say if holding period is 1 year, how do we calculate what is the value of a share? It is simple. Now, before we go ahead, this also, we simply know the fundamentals. How do we derive the value? There may be different techniques, there may be different approaches, but the basics, the fundamentals still remain same. that value of a share, value of a debenture, value of an asset is always going to be present value of future cash flows. Now, if you are going to invest in a particular share just for, let's say, 1 year, if you're likely to invest in that share just for only 1 year, because your intention is after 1 year, I'm going to sell it off. Okay. If you're intending to sell the shares after a year, then can you tell me what cash flows are you likely to get from that security? If you're intending to hold the share for just 1 year, what cash flow are you likely to get? Yeah. What will be the cash flow that you will receive? One is, of course, the dividend that we are going to receive in at the end of the year, and the second is the sale price, right? So the second is the simply the sale price. So when we are trying to calculate the value of a share with the intention of just 1 year holding, so what we are expecting is, in the next, expected cash flows are simply going to be your dividend for 1 year and the price of the share in 1 year. So what should be the current price? First, we need to say what are the expected cash flows. Expected cash flows is D1 and P1. Now, what is D1? D1 is the dividend at the end of the year. P1 is the price at the end of the year. So if I ask you, let's say D1 is 12 rupees, so you are expected to get a dividend of, let's say, 12 rupees, and price of the share, which is the price that is likely to prevail after a year, let's say price of that share is going to be 56. And let's say your cost of capital or cost of equity using the CAPM model, as of now, looking at the CAPM model, let's say it is 12%. Can you tell me what will be the value of share? What will be the value of the share here? If your holding period is, let's say, just 1 year. Yeah. If your holding period is just 1 year, what is likely to be the value of the share?
Jagbandhu ji,
Yeah.
one student
Yes,
is
sir.
also replying on this query handle. Are you
Yeah,
seeing
yeah,
it?
I'm looking at it.
This is Hemant Kumar, I think, Mahapatra.
Yeah, yeah. He's simply answering my questions, sir.
Okay, okay, okay. Just
Okay,
you
so
check it also.
yeah, yeah,
Yes.
he's not asking anything, just he's answering my questions.
Okay, okay. No
Just like
problem.
the
Just keep on checking and
yeah, yeah, I'm checking it. I'm checking it. Yeah. Yeah, okay. Okay, tell me, guys. So what will be the value of the shares? Yeah, so it's going to be the present value of the future cash flows, correct? So yeah, so value of the share will be like, can I just define it simply as D1 plus P1 upon 1 plus K? Can I say it makes more sense here because it's going to be the cash flows are going to be the dividend that we have in the first year end and the price that we have in the first year end. And then you simply take the present value of it, right? So it's going to be D1 plus P1, which is 68, and we divide it by 1.12, right, guys? So we just divide it by 1.12, and we arrive at the value as 68 divided by, yes, so 60.71 should be the price or should be the value at which this share should be available. Now tell me if this share is available at a price of 65. If this share is available at a price of 65, are you going to buy this share or no? No, because this is overvalued or undervalued. If the price of this share in the market is 65, is this overvalued or undervalued? It is overvalued, so they will not buy it. Simple. Now, of course, this is a very simple model, based on which we have to discuss more about, advanced model also. We're slowly and steadily building up models which are, we're making it more closer to the practical or a real life scenario, right? So initially, when these theories develop, they always start with some, constraints. They always start with some assumptions, right? And those are simply 60.75 is what we are getting the value in over here case. But then we are going to build up models which are going to be getting advanced one by one and will be moving more closer to a realistic way. But they all are based on the initial number also, right? Now, this was the first case where we were discussing about the holding period is, let's say, 1 year. Okay. Now, if you are likely to hold the share for multiple years, now here is where, the interesting things start. If it is valuation based on multiple holding period, valuation based on, let's say, multiple holding periods. So let's say you are going to hold it for a really long period. So how do we go about the valuation of the shares, right? So there again, we have like three different areas. First thing is zero growth. The first part that we have is zero growth. So when we say zero growth, it means there's no growth in the dividend, because we are looking at the dividend-based model, right? So as of now, what we say is there is no dividend growth. So let us assume that there is no growth in dividend at all. Okay. So the fundamental principle remains the same, right? So if there is no growth, how do we go about obtaining the value of the shares, right? So the fundamental is remains the same. Price of, not price, but yeah, value of share is simply going to be D1 upon, this is first year dividend, you divide it by 1 plus K, add to it again D1, because your dividend is constant, no growth. So D is, the dividend amount is going to be constant. So D upon second year, it's going to be 1 plus K square, right? So it goes on like this, right? So let me just write it and portray it to you. Let me just derive it. Yeah. So let's say dividend is what we are talking of. So value of share is simply going to be dividend upon 1 plus K. That's the first year dividend present value, plus dividend upon 1 plus K square. Right? That's the dividend for the second year. Then again dividend upon 1 plus K, one plus K cube, and this goes on till perpetuity. Now, does it seem like some mathematical expression to you guys? Does it seem like some mathematical expression? Yeah, it's a geometric progression, right? And if I ask you, what is geometric progression till infinity? What is geometric progression till infinity? I'm just checking your foundation skills, whether you have really learned quantitative aptitude in foundation. Yeah, what is this summation infinity? If you can remember, it is a upon 1 minus r. Do you remember this? A upon 1 minus r, right, guys? So if we simply apply the geometric progression fundamental over here, where a is the first term is dividend upon 1 plus k. And what is getting multiplied every time? It is 1 minus r is basically 1 upon 1 plus k, because every time you see, 1 plus k is getting multiplied every time, correct? So this is d1 upon 1 plus k, the whole thing divided by 1 plus k minus 1 upon 1 plus k. And when you cancel it out, we are left with, there is no d1 as such. We are left with just an expression of dividend upon k. So can we say value of a share with no growth in dividend? What will be the value of a share with no growth happening in the dividend? What will be the value of the share with no growth happening in the dividend? Can I say it is simply D divided by K? Is this point clear, guys? Yeah, so value of a share with no growth, it's going to be D divided by K. Correct? Simple. Now, this was a zero growth scene. Now, let us say there is a growth which is happening in the share. or we can say there is a constant growth in dividend. And this is going to be continuing till, let's say, perpetuity. So suppose there is a constant growth that we have till perpetuity. How do we get the value of a share? How do we get the value of the share if there is a constant growth happening in the dividend till perpetuity? If there is a constant growth happening in dividend till perpetuity, how do we get the value of the share? Can you recall something? Yeah, Mamta.
Good morning, sir.
Good morning, Mamta.
Sir, in this dividend growth model,
Dividend?
dividend price model, valuation
Yeah.
based on when zero growth, it
Ah.
means we have no dividend.
No. Zero growth means dividend is not growing. Whatever dividend is paid now, it is going to be paid same constant till perpetuity. It doesn't mean no dividend.
Okay, understood.
Okay, yeah. So here we are looking at the companies where we have got the companies are basically paying dividend. Okay. So if the companies which are not paying dividends, how do we go about with them? Then we'll go for earnings based model, or we will go for cash flow based model at a later stage. Okay. Fine. Coming to this constant growth in dividend till perpetuity. If you have a constant growth in dividend till perpetuity, how do we arrive the value? Yes, you have learned this in your intervals. You have learned this in your inter. But I will derive this for you for the time being, because these are some things, derivations which you can understand quickly. So we'll just take a minute and we'll quickly derive it. And obviously, it gives more sense of understanding in that situation. So we'll say year of growth, let's say value of share will be, can I say dividend in the first year upon 1 plus KE. Okay. Then if we are looking for, let's say, another year, second year dividend is going to be D1. On that, there is a growth pattern happening. So it is going to be 1 plus growth rate upon 1 plus KE square. Now, of course, in the third year, it's going to be D1 into 1 plus growth upon 1 plus KE Q. And this is going till perpetuity. Again, do you see any pattern in this, guys? Do you see any typical pattern in this? Yeah? Do you see any pattern in this? Is it a geometric progression or no? Yes, it is, right? It's a geometric progression, there is. Correct? Okay, so it's again similar to the previous thing that we were exploring. Correct? So again, this is a sort of geometric progression where the first term, where we have the first term as d1 upon 1 plus k, and the growth, the multiplier, every time what is getting multiplied? 1 plus g upon 1 plus k. You can observe that d1 is multiplied with 1 plus g upon 1 plus k. Again, this is further multiplied by 1 plus g and then 1 plus k. So every time you have a growth happening, right? So you can understand this as, like, suppose year and the dividend. Let's say in year 1, you have a dividend of 10 rupees. Second year, you will have a dividend of, let's say it is growing at, let's say suppose it is growing at a rate of 10%. So second year dividend will be how much, guys? If your year 1 dividend is 10, what will be the second year dividend? If the growth rate is 10%. If the growth rate is 10%, what will be the dividend in the second year? It will be 11. What about third year? What about third year? Third year, what will be the amount of dividend? If we are saying that it's growing at 10% every year, can I say it will be 11 into 1.1, right? So it goes on like this till perpetuity. Okay. So then we can say, using this question, value of the share will be simply A upon 1 minus R. And when we do this A, which is D1 upon 1 plus K, divided by 1 plus or 1 minus 1 plus g upon 1 plus k. And then when you solve this, we arrive at a value of the share as E1 upon k minus g. Have you, can you recall this formula somewhere from your CA Inter? D1 upon k minus g, right? We have done this formula in CA Inter. I just gave you a logic for this. Okay. This derivation is not a part, but what you should know is the value of the share with a constant dividend growth rate is going to be D1 upon k minus g. We can also write it as D0, which is the last year dividend, into 1 plus g upon k minus g. Okay, so that's the mathematical expression, correct? That's how we come at the value of the share if there is a constant growth happening in the dividend till perpetuity. And this model is actually called as Gordon's model. This is called as a Gordon's model. Okay, this is a Gordon's model. I hope you can recall this. And if not, you have understood what this model is basically assuming the growth rate pattern to be. Okay, shall we proceed? Guys, are we good till now? Everyone? Are we perfect till now? Yes? Okay. Now, if you can recall in CA Inter, something problem was there in this Gordon model. What was that shortcoming of the Gordon model, guys? If you can just recall. What was the shortcoming or what was the something was lacking or there was a problem in this Gordon model. Can you recall what was the problem in the Gordon model? Risk is already taken care of. When you have a risk, it's already taken care of in K. K is obviously taken care of. I'm not talking of the, okay, constant growth rate may not be there. That's okay. Constant growth may not be there. But, some problem is there with this model because of which you may get absurd answers. You may get absurd answers. Like if everything is same, you may get absurd answers in this particular form, in this particular model. Just think of a scenario. Cost of equity is, let's say, 15%. And the company is growing, let's say, at 20%. Cost of equity is 15%, and the company is growing at cost of equity is, let's say, 15%. Company is growing at, let's say, 20%. Then what will be the situation? What will be the answer for this? Can I say this will give you a negative answer, right? So if it's giving, that's the shortcoming that we have. Sir, if your cost of equity is lesser than the growth rate, denominator will become negative and overall answer will become negative. And this is obviously an absurd answer, right? Okay. So that's the problem with this model. Now to remove that problem, we have some more advanced, models over here. Okay. Okay. Now, how do we remove that problem? So then we have again in the dividend model itself something called as two-stage and three-stage dividend model or multiple growth rates, variable growth rate. So when we have variable growth rate, how do we determine the value of the share? Now in the variable growth rate, we are going to essentially look for something in a sense that one of the ways is two-stage model, two-stage dividend discount model. Okay. Now what's this two-stage dividend discount model? See, we say that, okay, current dividend of ours is, let's say, 10 rupees. Okay. So let's assume that current dividend is 10 rupees. And when we look at the growth rate, we are having two different growth rates. One is a super growth rate and other is a normal growth rate. So let's say growth rate is 20% for 3 years. And of course, this is going to be the super growth rate. So growth rate is 20% for 3 years, which is a super growth rate. After 3 years, we say from year 4 onwards, we can say that the growth rate stabilizes to, let's say, 10%. And this from this year 4 onwards, now this becomes a normal growth rate. So 20% initial years, you have a super growth rate growing at a very fast rate. After that, your growth rate is going to fall because it is quite obvious that you take any industry, you will not find that industry grows for an infinite period at a very high growth rate, right? So whenever we have a company which is coming up with, let's say, some innovative product, okay, let's say company is coming up with some innovative product or something which is very new in the market, no one has done it, and people are really excited about it, the sales are zooming. So there you will have a very fast growth rate in few years, right? Maybe 5 years, maybe 10 years, maybe 20 years. But after a period of time, can I say it has to settle down at a normal growth rate? Am I right, guys? Everyone agree with me? Can you have really a company or any product which will have a super growth rate till perpetuity, sir? Have you ever observed any company which is giving you super normal growth rate till perpetuity? So that company was there, 100 years back, and now also it is giving us, let's say, 20-25% growth in earnings. It's not possible, right? Because in real life scenario, when we actually sit down and calculate the value of the companies, we don't observe that companies are really doing good for a longer period of time. So practically also we have observed that high growth rate is not possible for a longer period. It will be there for certain period, but then after that, after that particular number of years have passed, it will settle down to 10% or it will settle down to some constant growth rate, right? So here we say that dividend is going to grow at a super growth rate for, let's say, 3 years. And then after that, from year 4 onwards, it will settle down to a normal growth rate of, let's say, 10%. Okay. Now, how do we value these companies? How do we value these companies? So let me just say your cost of equity is suppose 12%. Okay, cost of equity is 12%, and we just want to take the value of it. Now, it is quite obvious that I'm just trying to draw a timeline to make you understand what we are really trying to discuss over here. We are trying to value the company time 0. Now, year 1, 2, 3. And then, of course, year 4, year 5, year 6. So in year 1, the dividend is happening, dividend is growing at, D0 is, let's say, 10. So what do you expect? What will be the value of dividend in 1 year? What will be the value of dividend in 1 year? What will be the value of dividend in 1 year? Like last year, the company has paid a dividend of 10 rupees. Growth rate in dividend is going to be 20%. Growth rate in dividend is going to be 20% for next 3 years. So can you tell me what will be the amount of dividend in year 1? Yeah. In year 1, can I say the dividend is going to be 10 multiplied by 1.2, which will be 12 rupees? Correct, guys? In year 1, our dividend is 12 rupees. What about dividend in year 2? Can you tell me what will be the amount of dividend in year 2? Can I say it will be 12 multiplied by 1.2, because that's the dividend which we have in the second year. What about dividend in third year? Can I say 14.4 into 1.2? 17.28, correct? What about dividend in year 4? What will be the dividend in year 4 now? Tell me. Now the dividend in year 4 will be growing at what rate? It will be growing at 10%. From 4th year onwards, it's going to grow at 10%. So whatever is your dividend in 3rd year, on that you add 10%. So this into 1.1. So this becomes like 19. So we have a dividend of 19 in year 4, right? Year 5. What is year 5? What will be the dividend in year 5? That's 19 into 1.1. So that's 20.91. Correct? And year 6, obviously, this is going to be into 1.1. So that becomes like 23. So the dividend is 23 rupees, correct? Now, one point I want you to highlight over here is, can I say the company actually enters a constant dividend growth phase from year 3 onwards? Can I say it, guys? Yes or no? From year 3 onwards, that is after year 3, the company is actually becoming like a constant dividend growth company, like the Gordon model. Correct, guys? So from here, that is from year 3 onwards till this entire phase, after year 3 onwards, the company actually becomes a constant dividend growth company. It becomes a constant dividend growth. Right? So from here onwards, you say constant dividend growth rate is applicable, or I can say this becomes more of like a Gordon model. This becomes more of like a Gordon model from year 3 onwards. Correct? So now, if I want to say value of the company in year 3, value of the company in year 3, how can we determine the value of the company in year 3? You remember something like value in year 0, it was D1 upon KE minus G. On the similar lines, can you tell me what will be value in year 3 of the company? What will be V3? What will be the value of the company in year 3? So V3 will be what? Instead of D1, what will I say? Instead of D1, what will I say? What will we have instead of D1? What will like in year 0, you took the D1. But when you are in value in year 3, what will be the D1 number? D1 will be D4. See, when you want to value in year 0, you take D1. When you want to value in year 3, you will take D4. Are you getting it, everyone? It's not going to be D3. Understand that when you're getting the value, trying to get the value in year 0, you took D1. But when we want to get the value of the share in year 3, we will take which value? D4. Correct? So D4 divided by KE minus G. So can you tell me what will be the value over here? Right? What will be the value in year 3? Can I say it is going to be D4 upon KE minus G? So what will be D4? What will be D4, guys? D4 is 19 upon, what is K? K is 12% minus 10%. So this is 19 divided by 0.02. How much is it? Hence it's turning out to be 950. Correct? Okay, tell me, is this 950 value of the share today? Is this 950 value of the share today? No, this is the value of the share at the end of, this is the value of the share at the end of 3rd year. Perfect. This is the value of the share at the end of 3rd year. But are we really interested in knowing the value of the share in the 3rd year? Are we interested in knowing the value of the share in 3rd year? We want to get the value of the share today. So if I want to get the value of the share today, what will be the value, sir? It will be simply going to be present value of the future dividends for the next 3 years and also value of the share that you're expected to get in the third year. So can I say a simple fundamental value in year 0 will be equal to first year dividend upon 1 plus k, second year dividend upon 1 plus k square, third year dividend upon 1 plus k cube. But along with that, I will add value in third year upon 1 plus k cube. If I buy the share today, if I'm going to buy the share today, what am I going to get in future? If I'm going to buy the share today, I will get dividend for 1 year. I'll get the dividend for second year. I'll get the dividend for third year. And also I will be having a share which is worth 950 rupees at the end of third year. Correct? So how do we get this value now? Can we simply derive this as year and cash flows? So in first year, second year, third year, wait, I'll just do one thing. Yeah. So we get dividend, right? Then, or this is, I can say E1, this is second year dividend, this is third year dividend. But third year, can I just club together the third year dividend and the value? Can we simply club together the third year dividend and the value? Yes or no, guys? We can club it together, right? Because they are occurring at the same time. So what is the cash flow in first year? First year dividend is how much, sir? 12. So first year dividend is 12. Second year dividend is, we have computed the second year dividend, which is 14.4. Third year, we have a dividend of 17.28 and also the market value of the share, which is 950. This is what the cash flows are, right? So 12, 14.4 and 967.28. Yes. Now, how do we get the present value? We simply multiply it with the present value factors. Now, present value factors, what was the cost of capital that we have taken? Cost of capital is 12%. So, present value factor at KE equal to 12%, right? Then that becomes like 1 divided by 1.12. Right? And then we get these values. Present value will be cash flow multiplied by the PV factors. Then we arrive at this particular number. So current value of the share should be 710.7 lakhs or 710.68. Just should be the current market value of the share, not market value, current fair value of the share if we are assuming two-stage dividend discount model. Is this concept clear to you, everyone? The two-stage dividend discount model. Is this clear to everyone? Yeah. Okay, Karthik. One doubt only. How come when growth rate is changing, our cost is still the same? As well, calculating cost also we consider growth rate. Karthik, we don't consider here. Here K is not computed using the growth rate aspect. Here K is computed using CAPM, which is capital asset pricing model. So in that CAPM, we consider the risk of the company by way of beta. Correct? Got it? So therefore, there we are not looking at the growth aspect. Okay, so can I give you a question to solve on the similar lines? Will you be able to solve it? Yeah, or let's do it together, right? So let's take a question from the assignment to discuss the two-stage dividend discount model. Just see question number. Yeah, this should be question number 3 possibly. Yeah, question 3, guys. Let's try to solve this question number 3 now. What is two stage about this discount model? There are two stages, right? Two stage in a sense that there is a growth rate or a super growth rate and a normal growth rate. So there are two different stages. So one thing I just missed out, this 950 which we get is also called as terminal value, by the way. Is also called as terminal value, and this is the terminal value and in year 3, because we know that this is belonging to the third year. This value is belonging to the third year. So this is, we don't call it as value in year 3. We say it's a terminal value in year 3 because we're likely to get a value of 950 in the third year. Okay, guys. Okay. Now let's look at this question number 3 and try to solve it. Yeah, look at this question. MNP Limited has declared and paid an annual dividend of 4 per share. So can you tell me what is this 4 per share? Can you tell me what is this 4 per share? It is D0, correct? So D0 is 4 rupees. It is expected to grow at 20% for next 2 years and 10% thereafter. So growth rate, we have got growth rate to be 20% and 10%. So what is this 20%? What is this 20%? What is the name that we have given for the higher growth rate? Super growth rate, right? So there is this super growth rate happening. And then we have a normal growth rate. Okay, so we have super growth rate and then the normal growth rate. After that, have they given us the required return on the required rate of return of equity investors is 15%. So this is our KE, cost of equity is given as 15%, right? Now, first step that we calculate, what is the first step that we do? When we have, can I say again, it's a two-stage model, right? So when we have this two-stage model, what's the first step that we do? What's the first step that we do is? Yeah. D1? No. First step, we will obviously look at the calculation of the dividends, followed by the dividend, so followed by the terminal value, sorry. So here, and then we look at the dividends, right? So year 1, 2, 3. What is the first year dividend expected? Can I say 4 multiplied by 1.2, which is equal to 4 multiplied by 1.2, which is 4.8. What will be the dividend in the second year? Can I say it will be 4.8 multiplied by 1.2, which is 5.76. Correct? Now, what will be the third year dividend? Third year dividend will be 5.76 multiplied by how much? Will it be 1.2? Will it be 1.2? No, it will be 1.1, 10% growth, right? Because normal super growth is for 2 years, and this is from year 3 onwards. Okay, so 5.76 into 1.1. That will be into 5.76 into 0.1. So that is 6.336. Right, guys? So 6.336 is the rate of dividend that we are getting in the third year, or dividend that we are likely to get in the third year. This is the step number 1. Now, after this, at this stage, we will be able to calculate something called as terminal value in year. Can you tell me in which year are we going to calculate the terminal value? In which year are we going to calculate the terminal value? Is it going to be year 2 or is it going to be year 3? Terminal value in year 2, because we will be using the dividend of third year and discount it by and divide it by KE minus growth rate. Right? So that will be like dividend in third year is 6.336. That divided by KE, cost of equity of 0.15, minus growth rate of 0.1. Right? So what is the terminal value? What's the answer for terminal value, guys? This is 6.336 divided by 0.05. So 126.72. This is definitely the value that we have in year. This is the value that we have in year. In which year? This is value in which year? Value in year 2. So in the second year, we have the terminal value of 126.72. We took the dividend of year 3 to get the value in year 2. Got it? Now, after this, going for the step number 2 is simply calculation of value of share. Right? Calculation of value of the share. This is going to be like year, details, and the cash flows. It's like year 1, 2, and 3. It is like D1. This is going to be D2. And in the third year, not in the third year, sorry. In the second year itself, it is going to be D2 plus value in the second year, right? So first year cash flow is 4.8, second year cash flow is 5.76, plus the value that we have, which is 126.72. Correct? And then we simply take the present value. So we take present value factor at, what's the cost of capital here? 15%. So cost of capital is 15%. Then we take the PV. Okay. So yeah. So present value factor at 15% will be derived at 1 divided by 1.15 to the power of number of years. Right? So what will be the present value of each of those cash flows? That will be cash flow multiplied by PV factor. Right? Then when we take a total, we get this as 104.35. This is going to be the value of share today. Okay. Karthik is asking constant dividend growth rate में D1 year नहीं होना चाहिए. D1, I didn't get you. D4th year you are saying, Karthik. Yeah, you're saying D4th year? Well, D4th won't be here because the cash flows are becoming constant from third year onwards. So from here on onwards, the growth rate, dividend growth rate is constant. So we are getting the value in second year. Like in the previous example, the cash flows were becoming constant from fourth year onwards. So therefore, we got value in year 3. Here, the dividend is growing at a constant growth from third year onwards. And therefore, we got the value, terminal value in year 2. Got it? Are we clear, guys? Is this method clear? Yeah. Are we all clear? It is simple. Just take the present value of the dividend and the present value of the terminal value. Simple. Shall we do one more question for this? Yeah. Let's take one more question. Okay. Let's go for then. So we are done with, just take over here, question number 3. Let's do the question number. Yeah, question number 5, guys. Let's try to solve question number 5. Let's try to solve question 5. X Limited just declared a dividend of 14 per share. So can you tell me what is this 14 per share? What is this 14 per share? Just give me a moment. Let me take it to the other side. Yeah. So X Limited just declared a dividend of 14 rupees per share. So what is this 14 rupees? Can I say it is D0? D0 is 14, right? Mr. B is planning to purchase the share of X Limited, anticipating increasing the growth rate from 8% to 9%. Okay, which will continue for 3 years. So which will continue to for 3 years means when we look at growth rate of 9%, right? Growth rate of 9% is happening. Can I say this is possibly super growth rate maybe, right? He also expects the market price of this share to be 360. Can you tell me what is this 360 now? What is this value 360? Yeah, this is the terminal value. Terminal value in year 3. Or you can also say this is the price of the share in third year. Right? Now the question says, guys, that growth rate is expected to increase from 8 to 9%. Is expected to increase from 8 to 9%. So what does this mean? It means in the past, it has been growing at 8%. But we say that for the next 3 years, it is going to grow at 9%. Okay. So past has been like it has grown by 8%, but upcoming years, in the subsequent years, it is likely to grow by 9%, guys. Okay. So therefore, we say increase in growth rate is from 8% to 9%. So 9% is what we are looking at, the future growth rate that is coming up. Is it clear, Dhanya? 8% is the past. So whatever past has happened, that we are not yet considering. We are considering only the next year. So terminal value that we have in year 3 is 360. Okay. He also expects the market price of the share to 360 after a year. So you could determine the maximum amount which B should pay for the shares if he requires a rate of return at 13% per annum. Now, of course, what will be the cost of equity here? What will be the cost of equity, guys? Yeah, cost of equity will be 13%, right? Now, can we get the value of this share for the first part? Yes. You can get it simply as writing down the year, cash flows, or you can say the details, cash flow, PV factor, and then take the PV. Okay, I'll leave it up to you guys. Quickly calculate and give me the value of this. Just a 2-minute time for you. Write down the values. All the data is over here. Write down the values and give me the present value. Give me the present value of the cash flows. Yeah, guys. We have here 1, 2, 3. Details are like first D1, D2. Of course, D3 is what we are going to get. D3 plus P3. So the cash flows are 14 rupees that we had in the previous year. Of course, next year it's going to be 14, growing at 9%. Second year again growing at 9%. Third year, it's again growing at 9% plus 360. Just check if we have got these cash flows, everyone. Are we getting these cash flows? Yes. Then take the present value factor, 1 divided by 1.13 to the power of number of years. Right? These are the PV factors. And then when we multiply the cash flows with PV, and then simply take a sum of it. There may be some sort of error, or rather I can say, instead of this PV factor, I can actually utilize the PV factor given, right? Yeah, so I'll utilize the name 0.885, 0.783, and 0.693. 288.57 or 0.6 is the value of the share that we are getting. Am I right, guys? Did we get this value? 288.57. That's the answer to the first part of the question. Nine percent is the normal growth rate. We don't know what is the growth rate over here after 3 years. So they have just given us the terminal value. So okay, initial years you can say that it's just the norm, the super growth rate, because we are not aware about what's the normal growth rate. Okay, normal growth rate is something which we haven't been given. But if I just ask you, what is the growth rate anticipated? It's not asked in the question, but out of my curiosity, can any one of you calculate what is the growth rate implied by this terminal value? Can you calculate what is the growth rate implied by this terminal value? Let's see if we can really calculate the growth rate that is implied. Like we know value in year 3 will be what? Dividend in year 4 upon K minus G, correct? So this is obviously 360 equal to D4 is going to be like, what is the dividend that we have in the third year? What was the dividend that we had in the third year? Into 1.09, right? 18.13. Right? So dividend in the third year was 18.13 into 1 plus growth rate, right? The third year dividend, it was 18.13, right? Correct? Because it was 15.62 in first year, 16.62 in the second, and 16.63 add to it a 9% growth rate. So 18.13 into 1 plus G, and K is, let's say, 0.13 minus G. Can we solve this equation and get the implied growth rate, guys? The growth rate implied by the terminal value? Yes, it will be 360 into 0.13 minus growth is equal to 18.13 plus 18.13 growth. So 360 into 0.13 will be how much? So 360 into 0.13. That is 46.8 minus 360G is equal to 18.13 plus 18.13G. So bring growth numbers on one side and the others on the one side. So we can say 18.13G minus 360G is equal to the other terms on the other side fully. That's 18.13 minus 46.8. So 18.13 minus 46.8. That's 28.67 and 18.13 minus 360. That is 341.87 G. So growth rate which is implied over here is 28.67 divided by 341.87, which is 8.38%, right? The growth rate is 8.38. Right, guys? The growth rate that is implied over here is 8.38. Okay. So that's a growth rate, implied growth rate over here, which is, how if the terminal value is 360, then growth rate is supposed to be 8.38 or 8.39. Okay. Anyways, that was not required in this question. So one of you asked whether it is a supernormal growth rate. That's what I just tried to explain it to you. 360 gives minus 360 is, I'm keeping 360 on the same side. Abrakesh, 360 is on same side. 18.13 goes on the other side. Okay, yeah. So 18.13 will be minus. Yeah, so this will be adding. Okay, this is some different, right? Yeah. So that will get added, right? So this works out to be 1 second. 18.13 plus 360, right? So this is 378. 378.13. So growth will be 28.67 divided by 378.13. Yeah, so growth rate is actually 7.58. Right? Okay. So the normal growth rate is 7.18, the implied thing. 7.18 or 7.58, sorry. Some rounding up error may be there. Okay, let's go for the second part of the question now. The second part of the question says, what's the maximum price Mr. B will be willing to pay for share if he is of opinion that 9% growth rate can be maintained indefinitely and require 13% rate of return per annum. Now, what is this part, guys? What is the second part now? Tell me. What model is this? Is it still a two-stage model? Does it still remain to be a two-stage model, or does it become some other model? Because now they're saying that 9% growth rate will continue till perpetuity. It will go on till forever. It will go until forever. So what is this? It's a constant growth rate, right? Right? So Gordon model, right? So the second part is with a constant growth rate of 9%. So if it is a constant growth rate of 9%, what will be the price? I mean, value in year zero. What formula should I apply over here? What formula should I apply, guys? Can I say D1 upon KE minus G? Value in year zero will be simply the first year dividend. What was the first year dividend? What was the amount of first year dividend? 15.26, right? So 15.26 divided by KE. KE was 0.15 or 0.13. It was the cost of equity. Okay, they're saying assume cost of equity to be 13%. So cost of equity is 0.13 minus growth rate of 0.09. So now this becomes a Gordon formula, similar to Gordon formula. So value in year zero will be 15.26 divided by 0.04. So now the value becomes 381.5 as per this assumption that 9% is going to be the growth forever. Right? Now, next part is the price at the end of, remember, just take a note of it, that price, we want the price at the end of 3 years. We want the price at the end of 3 years. If 9% growth is achieved, assume all other conditions remain same over here. So they're saying if 9% is going to be the growth rate forever, if 9% is going to be the growth rate forever till perpetuity, what is the price that you expect in year 3? So the third part of the solution, we want to calculate price in year 3. Tell me, how will I get the price in year 3 or value in year 3? How do we get the value of the share in year 3 now? Tell me, guys. How should I get the value in year 3? Perfect. Correct, Vignesh. It is D4 upon KE minus G. So now D4 is something that we need to get. So how do we get the D4? D4 will be, of course, D3 into value in year 3 will be D3 into 1 plus the growth rate upon KE minus G. Right? Yeah. So D4 upon KE minus G. So value in year 3, we can get it D3 as, we've got the D3 value, right? I have written it here. D3 is this number. It is 18.13041. So 18.13 multiplied by 1 plus, what's the growth rate anticipated? 9%. So 1.09 divided by KE minus G. Now KE minus G will be, what's the cost of equity? Cost of equity is 0.13 minus 0.09. So value in year 3 will be 18.13 multiplied by 1.09 divided by 0.04 is 494.04. Yeah. Did we get this value in year 3, price in year 3, guys? Are we clear till now? The constant dividend, two-stage dividend discount model, all other aspects, right? Are we good? Have you all understood whatever we have done, everyone? Very clear? Okay, then let's do one thing. Let's take a short break, guys. Post the break, we will continue with some other models for valuing the equity shares. Okay, let's take a break, guys. Break of 10 minutes. Okay. Yeah. Are we all back after the break, guys? Good morning once again, everyone. Are we all back? Yes. Yes. Okay. So we were doing the two-stage dividend discount model. Let me take one more question of this model, and then we'll go for the subsequent discussion. Let's look at this question number. Six or one. Yeah, question number 6. Question 6 is Piyush Lunkar and Associates presently pay a dividend of 1 rupee per share. Can you tell me what is this 1 rupee? What is this 1 rupee dividend per share? D0, correct? Right? And it has a current share price of 20 rupees. The current share price is 20 rupees. Yeah. Yeah, so this company presently pays a dividend of 1 rupee per share, and it has got a share price of 20 rupees. Yeah, so it pays a dividend of 1 rupee per share and has a share price of 20 rupees. So we say that it is having a D0 of 1 rupee and it has a share price of 20 rupees. So share price means the current market price, right? P0 is 20. If this dividend were expected to grow at a rate of 12% per annum forever, what is the firm's expected or required rate of return using a dividend discount model approach? Which model should I apply over here? Which model should I apply over here to get the what is the firm's or required return on equity? We know the P0, we know the D0. We can of course get the D1 value also. D1 will be 1.12 because it's going to grow at 12%. And we want to know what should be the cost of equity. Now, I can definitely use a Gordon model, which is K equal to D1 upon P0 plus the growth rate, right? So we can simply say that cost of equity over here is D1 is 1.12, P0 is 20. Add to that a growth rate of 0.12, right? So how much is the cost of equity coming out to be? 1.12 divided by 20 plus 0.12, which conforms to a percentage of 17.6%. Simple. Now they say, instead of this situation, suppose that dividends were expected to grow at a rate of 20% per annum for 5 years and 10% per annum for the year later. Now, what is the firm's expected or required return on the equity? Now, here is something a bit challenging. They're saying that dividend is going to grow at 20% per annum for the next 5 years. After that, it is going to grow at 10% forever. And we want to know what is the firm's expected or required return on equity. We want to know the KE under this second situation. Now, we don't know what is the KE. We really want to know the value of the KE here. And don't you think that we can use this KE to calculate the other? No. This KE is calculated under an assumption of a constant dividend growth rate. I cannot use this KE again. Okay. So I need to just look at the KE of 17.6%. This works only if there is a constant dividend growth rate. But here it is a different situation. Here it's a two-stage model basically. So for the two-stage model, what will be the KE? That's what we need to compute over here as an implied rate. So we will have to essentially assume some rate and then try to calculate the value to be equal to 20, because we want to make the value of the share currently equal to 20. So we will assume a particular rate, try to get it, right? And then we will think of, whether increasing or decreasing it, right? So currently we got this, let's say KE as 17.6%. Let us assume the dividend discount rate as, and let the KE for two-stage dividend model be, let's assume it as maybe, suppose 20%. Let's think of it as suppose 20%, and then we'll take a call what is to be done. Okay, let us assume it to be at 20%. Let's try to see what's the what is the number that we are getting. Now, when we assume this to be 20%, and we have these parameters, which is T0 is 1, and growth rate, we have got two growth rates. What are the growth rates? 20% for 5 years, 10% for the years later. So it is 20%, which is the super growth for year 1 to 5. And 10% is the normal growth from year 6 onwards. From 6th onwards, we have this normal growth rate. Okay, so normal growth rate is from year 6 onwards. Correct? 10% per annum thereafter. Okay. So how do we get this now? If we are assuming that the K is 20%, or so, once again, if growth rate is 20%, if we take 20%, there will be some problem. So let me just change the assumption, because before you take the growth rate, take the K, you need to also check the growth rate, right? So we can take 20%, but not to take less than 10%. Just keep in mind. You can take 20% for the time being, because 10% is the normal growth rate. So your KE has to be, as per the constant dividend model, Gordon model, the KE has to be lesser than the normal growth rate. So that's okay. 20%, KE has to be greater than the normal growth rate. 20% is okay because it's greater than this. Now here, the first step that we do, what are the steps that we do? First, we write down the year cash flows, right? Year details, cash flows, PV factor, obviously at the assumed rate of 20%, and then PV, right? So year 1, 2, 3, 4, 5. Okay. And details, we say it is going to be D1, D2, D3, D4, D5. And of course, in the 5th year, we'll have one more thing, which is the price in the year 5. Now, how do we get the price in year 5, guys? Tell me. How will I get the price of the share in year 5? How will I get the price of the share in year 5? D6 upon K minus G. Perfect. Okay, so can I say, let's first get the D6 value. Let's first get the D6 value and then go ahead with this table. So D6 will be equal to, it will depend on your dividends, right? So cash flows in year 1 will be, because the current dividend is 1 rupee, that is going to grow at 20%. So 1.2 into 1.2 again. So every time it is going to grow by, what do you say, 12%. So by the end of 5th year, this would have become 2.49. By the end of 5th year, the dividend would have grown to 2.49. So can you tell me what will be the dividend in year 6? It will be D5 into 1 plus growth rate. D5 into 1 plus growth rate. So D5 2.49 into 1 point growth rate is 10%, right? Because from 6th year onwards, it's a constant growth rate. So now it will be, of course, 2.73. Yeah, I'll just wait for a couple of minutes, guys. Just check if these numbers are what you're getting. Just check if you're getting these numbers as the dividends and the dividend in year 1 to 6. Just check if you're getting these values as dividend, everyone. Yes, please confirm. Are we all able to get these values? Fine. Okay. So now we have got the D6. We need to get the P5. So of course P5 will be the dividend 6 upon K minus G. So this becomes like, this is equal to T6 is 2.74 divided by, what was the assumed K? Assumed K was 20%, right guys? We assumed the K to be 20%. So this will be 0.2 minus growth rate is 0.1. Okay. So what is the value? What's the D6 value is? 2.74 divided by 0.1, which is 27.37 or 27.40 is what you can say. So this is 27.40. This is the price that we expect it to be in year 5. So in 5th year, we take this as 27.4. Okay, so in 5th year, we take this as 27.4. Now, use the PV factor at 20%, and then you have to get the PV. So PV will be 1 divided by 1.2 to the power of number of years. Is the question giving any PV factors? No. So we can calculate it and write it over here. Just verify if these are the PV factors. Just check, guys. Check with the PV factors. Are we getting these PV factors? Yes. Okay, yeah. So present value will be cash flow multiplied by PV factor. Cash flow multiplied by PV factors. And then I take a total of all the present values. This is coming out to be 16.01. So when we assume that the K is 20%, we are finding that PV is 16.01. Right, guys? So of course, we have assumed the PV factor at 20% and the growth rate is also 20%. So every time your dividend grows by 20%, it's get again discounted by 20%. Therefore, you have a PV as 1. Okay, so there's nothing to worry about that. So we got this value as 16.01. But what is the value that we were really looking for? In this question, what is the value that we want for the share? We got the value to be 16.01, but under an assumption that the two-stage that the cost of equity is 20%. What is the value that we were looking for? Can I say the current market price is how much? 20, right? So is our assumption of 20% KE correct or incorrect? So our assumption about KE of 20%, is it correct or incorrect? Incorrect. So what should I do with this 20%? Should I increase this 20% rate of discounting or should I decrease the rate of discounting? Should I increase the rate of discounting or decrease the rate of discounting? We'll have to decrease it because I want to increase the value, right? Since we want to increase the value, the rate of discounting should be reduced. Okay. So again, we'll say by the trial and error, let K for two-stage dividend discount model be. Now let us say it as 18%. Assume the rate of discounting to be 18%. It is an assumption because I want to reduce it from 20, right? I want to reduce it from 20, I want to reduce it to 20, right? I want to reduce it at 20. So to make it up to 20 rupees, since we want to, we want to increase the value of the share from 16 to 20. So rate of discounting has to be reduced. So you can take anything below 20, maybe 15, maybe 16, maybe 18. You can do it anything. Is it clear, Danya? I'm just taking it at 18% because I think 18% we should be able to get it. Okay, now this same thing, this entire procedure needs to be done for 18% also, right? And then we have to arrive at the value. Can you do this? I can give you maybe 3 minutes for that. Just scribble it and try to get the value. Can we do it? Yes, guys? Same thing. Same set of calculations with 20% now. So, sorry, with 18% as the cost of equity. So, growth rate is 20%, this remain 10%. So, we will have like cash flows will remain same. The only thing that's going to differ is the PV factor and the PV, right? So try to get the price in year 5 first. Cash flows are going to remain same. Only the PV factor, PE, and the price is going to change a bit. So first try to give me the price of the share in year 5. So P5. Give me the value of P5. Give me the value of the share in year 5. Yeah, guys. Give me the value of the share in year 5. How much is it? Yeah, it is 34 point. B6 will be, of course, 2.74, right? That divided by KE minus G. So KE is like 0.18 minus growth rate of 0.1. That gives us a value of 2.74 divided by 0.08. That's 34.21. 34.2125, that's okay. Now, of course, the value changes 34.21. Now, of course, the PV factor needs to be taken as 18%. It needs to be taken at 18%. So it will be 1 divided by 1.18 to the power of number of years. And then take the PV, which will be cash flow multiplied by PV factor. We check what is the price that we are getting. 20.22. Right? So value is 20.22. So now, have you all got this 20.22, everyone? Yes, 20.22 is done. Perfect. Now, what's the problem? We want to get the value to be, 20.22. So we have like KE and the value, right? So at a KE of 18%, we had the value of 20.22, and at a KE of 20%, we had a value of 16.0. What is the value that we were targeting for? What is the value that we were targeting for this? 20. So how do we get that 20? I hope we know the IRR method, interpolation method, right? Correct? By using IRR method, right? So we're looking for a change. Change over here is 2%. So there is a change of 2% in this case. There's a change of 2%. So you can use the IRR method. So we can calculate KE as lower rate plus NPV at lower rate upon NPV at lower rate minus NPV at higher rate. This entire thing multiplied by change in K. You can use the IRR method and calculate this. So lower rate is like 18%. To that we are going to add NPV at lower rate, which is 20.22. We'll say, yeah, NPV at lower rate, which is, let me just do one thing. This will be like price at lower rate. And I don't know if you can remember this method of IRR. We used to make it like using the interpolation thing. So at 18%, we had a price of 20.22. At 20%, we had a price of 16.01. So the change in the rate was plus 2%. What is the change happening in the value? Change that is happening in the value is 2 point, or I would say is 16.01 minus 20.22. So value has reduced by 4.2. But what is the value that we were looking to reduce? We wanted to reduce it to 20, right? So from 20.22 till 20, so we wanted a change of, we wanted a change of 0.22, right? We wanted to reduce it by 0.22. We wanted a change of 0.22. Here there was a change of 4.2, 4.21 maybe. Okay, so we want to see what is the change in percentage should be. So change in percentage would be simply cross multiplication. Let me express it in percentage. So 0.21%. So we can say KE is equal to 18% plus 0.1%. So essentially the KE is working out to be 18.1%. 18.096 or 18.1% should be the rate, should be the cost of equity, implied cost of equity for this scenario. Yeah, did we get this? IRR, everyone? IRR method or the YTM method or whatever you call. K is 18.1%, correct? You would have done this in interlevel, the IRR calculation, yes? Haven't you done this? Okay, I'll just repeat it. See, I hope you're clear that we got this 18% value and 20% value. Correct? 18% value of 20.22 and 20% value of 16.01. Okay. So at 18%, we had a value as 20.22. At 20%, we had a value of 16.01. What is the value that we were looking at? Of course, 20. So what we say is, when the rate of discounting or KE increased by 2%, when the rate of discounting or KE increased by 2%, what was the change that we observed in the value of the share? When KE increased by 2%, what was the change in the value of the share that we observed? What is the increase in the value of the share that we observed? Can I say share price reduced from 20.22 to 16.09, 16.01? So value of the share reduced to by 4.21. Correct? Yes, Ginny and Savita. Did we get this? When the rate increased from 18 to 20, there was an increase of 2% of YT, 2% in the K rate. But the change in the price was 4.21. But did we want to change the price from 20.22 till 16.01? Or do we want to constrain it at 20? We want to stop it at 20, right? We want to reduce the value only to the extent of 20. So only to the extent of 20 means, what is the value decrease that you were looking for? We want to change it by what? 0.22, right? So for 2% change in the KE, the value changed by 4.21. But we want to change it only by 0.22, correct? Am I right? Ginny, Savita. We want to increase, or we want to reduce the value from current 20.22 that we have at 18%. We want to make it to 20 rupees. So that's simply minus 0.22. Correct? So for 2% change, there was 4.2 rupees change in the value. So for 0.22 change, what should be the change in percentage? Simple cross multiplication. Like for 2% change, there was a change of 4.2. So for 0.22 change, what should be the change? That is obviously plus 0.1%. So I should increase my KE by 10%, or sorry, 0.1%. So the KE will become 18.1% as an approximate for getting the value as 20%, 20 rupees. Clear? Yes? Perfect. Okay, fine. So that is the question number 6, which we wanted to discuss. That is done by us. Now, let's go for another approach, because we were looking at the dividend discount model. There is a 3-stage dividend discount model also. Okay. But right now, I'm not going to do that, because that will be, requiring a little bit of more attention from your end. And I'm not doing that 3-stage dividend discount model right now. Okay. So just keep a note of it. I'm not doing that 3-stage dividend discount model now. Just remind me tomorrow. Tomorrow we will be doing that dividend discount model. And what we are really looking right now is the other equity valuation models. Okay. Will you remind me, guys, tomorrow? Will you remind me about the 3-stage dividend discount model? Okay. Morning, if I forget, you should remind me. Can I believe you? Yes? Okay. Fine. So let me just do the other models right now. Okay. Earnings based model. Let's do the earnings based model. Achha, can you tell me what are you going to remind me tomorrow about? What are you going to remind me tomorrow about? 3-stage model. Perfect. Okay. Okay. That actually requires a bit of more attention. It may take longer time to discuss. And therefore, I'm just skipping it for the time being. We'll take that up in the next session. Right now, let's go for the other models, which are the earnings based model, and of course the cash flow based model also. Now, earnings based model, again we have something called as Gordon model, Walter model, and then P ratio or multiplier approach. First one is the Gordon model. Now, Gordon model is just for namesake, we can say it's an earning based model, but essentially we are looking at the amount of dividend that the company is paying. Okay. Gordon model, we know it is P0 equal to D1 upon KE minus G. Okay. Instead of writing D1, instead of writing dividend, I can simply say EPS. Can I say EPS in year 1 into dividend payout ratio upon KE minus G? Can I say it like this? Yes or no, guys? Tell me. Can I say this as instead of saying as instead of simply stating that it is dividend upon KE minus G, can I say whatever is the earnings of the first year, you multiply it with dividend payout ratio? Can I say this? Yes or no, guys? Suppose if the earnings per share, let's say earnings per share of next year is expected to be 10, and I say we are likely to pay, suppose 40%. We're likely to pay, let's say, 40% of our earnings. So can you tell me what will be dividend in year 1? Can I say it is 10 plus 10 into 4 rupees? So how did we get this? This is what it has EPS multiplied by dividend payout ratio. Correct? So this is EPS 1 upon into dividend payout ratio. Okay. I can also call this as P0 equal to, instead of EPS 1 into dividend payout ratio, we can call it as EPS 1 into 1 minus P upon K minus G. Can I say it like this also? Yes, obviously. Because 1 minus B, what is B? What is B over here? What is B over here? Retention ratio, right? B is retention ratio, guys, correct? B is the retention ratio. So like if dividend payout is 40%, can you tell me what will be the retention ratio? What will be the retention ratio? Can I say 1 minus 0.4, which is nothing but 40%? Sorry, 1 minus 0.4, which is nothing but 60%, 0.6. The retention is, can I say 0.6? And if I say, sir, it is EPS 1 into 1 minus P, is the retention ratio, that will be EPS 1 multiplied by 1 minus 40%. Can I say 6 rupees? This will be this number, right? Can I say it is 4 rupees? Same. So can we say D1 is same as EPS 1 into 1 minus B? Can we say that? Yes or no, guys? D1 is nothing but EPS 1 into 1 minus B, and B is the retention ratio. Okay. Can you tell me how do we calculate this retention ratio, by the way? Retention ratio is what we know. Can you tell me how do we get the growth rate here? How do we calculate the growth rate? Have you heard something called as B multiplied by R? B multiplied by R? Yes or no? In your CA Inter, in the chapter of dividend decisions, you might have learned this concept of growth rate equal to B into R, correct? Right, guys? right? So it is nothing but B into R. B is what we know as a retention ratio. And what is that R number over here? What is that number R? What is the number R? R is the rate of return on investments, right? So rate of return on investment is what your R. So it is very simple. Like B is what you're retaining. Whatever you're retaining, if you reinvest it, whatever you're retaining, if you're going to invest it, can I say then only you are going to get the growth rate. Growth rate is basically what? Increase in your earnings or increase in your dividend. That is possible only if your retained earnings are there. So if you have retained earnings, you invest it, and the return that you get, that will be the additional income that you receive, right? So this is basically what we have as the Gordon model, which is similar to what we just stated. It is just elaborated in a more detail. Just elaborated in a more detail. Okay, that's your Gordon model. Now, I think you might have heard something of this Walter model also. In your CA Inter, dividend decisions. Do you remember Walter model? Or Walter's approach of calculating the value, right? So it's P0 equal to, Walter was what? Dividend plus earnings minus dividend, right? Is multiplied by R upon, multiplied by R upon K, and the whole thing was divided by K. Correct? Write it this, I can just write it at like this. So P0 is dividend plus earnings minus dividend into R upon K, and the whole thing divided by K. This is what we remember, Walter model. So why did we have this Walter model? Because there was again a problem with this Gordon model. K minus G that we did. Here there was an assumption that growth rate cannot be more than K. So to remove that portion, model was revised over here by Walter, and this was the this was the model given by Walter for determining the price of a share. Correct? Another approach, earnings-based approach, is to get the price earning. We have like price earning ratio, or you can say multiplier approach. Are we aware what is a price earning ratio? P ratio. You know P ratio, right? Price to earning ratio. We all are aware about P ratio, correct, guys? Okay, how do you compute the price to earning ratio? We compute the price to earning ratio as market price per share upon earnings per share. Perfect, guys. Now, let's just take an example to help you understand how do we use this P ratio to arrive at the value of a share. Okay. So suppose there are three companies, X, Y, Z. X, Y, Z are the three companies that belong to a particular industry, and they have reported their EPS and NPS. So suppose X has reported an EPS of 2 and a market price of 25. Can you tell me what is the P ratio for X? What is the P ratio for X? If X is having the EPS of 2 and NPS of 2 or 25, what is the P ratio for X? Can I say NPS divided by EPS, 12.5? Or Y, let us say the earnings is 4 and suppose the the market price is 44. So what's the P ratio for Y? 11, correct? For Z, let's say it has got a earnings of 2.5 and its market price is, let's say, 30. So what's the P ratio over here? 30 divided by 2.5, which is 12. So these are the companies that are prevailing in a particular sector. Let's say steel sector. Like, so in a steel sector, we have these three companies whose P ratios are available. Now, if we give you EPS for a similar sector company, EPS for a similar sector company under valuation. So we want to value shares of one of the companies which is into the same sector, which is into the similar business. So let's say it has got a EPS of 3.5. What should be the approximate ideal value of this share? What should be the approximate ideal value of this share? Can I say, first we will try to calculate P ratio of the sector, right? Or instead of P ratio, I can say more appropriate, average P ratio of the sector. So what will be the average P ratio of the sector? Average P ratio of the sector. Can I simply take an average of these three? Right? Because one of the companies having a P of 12.5, other is having a P of 11, and Z is having a P of 12. So basically their market price is 12.5, 11 point times, and 12 times of their earnings. So if we take the average of all the three numbers, can I say this comes out to be 11.33? So this means on an average, this sector has got a P ratio of 11.83, which means for 1 rupee of the earnings, the market price should be 11.83. Correct? For 1 rupee of the earning, the market price should be 11.83. So, can you tell me approximate value of share of the company? What should be the approximate value of the company of this share? Can I say, sir, EPS of that company into 11.83 of the P ratio of the sector? You can simply say it is 3.5 multiplied by 11.83. That works out to be 41.42, possibly 41.42 or 43, whatever number it is. Right? So approximate 41.42 is the value of it. I don't know if you take it like perfect number, maybe you will have a different thing. 41.41. 41.41 will be the value of the company. Got it, everyone? Yeah, so that's how you use the P ratio approach. You try to get the P of the other companies in the sector, take an average of the P ratio and apply it to your earnings. It's a very simple technique, right? Are we good with this three earnings-based approach, guys? Gordon model, Walter model, and the price to earning or the multiplier approach. Yes, we are good with this. Yes, perfect, everyone. Great. Now, let's do a question based on these models. So we have like question number, initially the question number, question number 1. First question is, this mark over here, we've done question 6. We've done question number 5 also. Yeah, let's come to question number 1, guys. The company has a book value per share of. Thank you, Ginny, for your compliments. I'm obliged. Happy to know that you're enjoying the lecture since start. Thank you very much. Question 1. A company has a book value per share of 137.8. Its return on equity is 15% and it follows a policy of retaining 60% of its earnings. If the opportunity cost of capital is 18%, so opportunity cost of capital is basically your cost of equity. Compute the price of the share today using both dividend growth and Walter model. Okay, let's just take down some basic numbers. We have a current book value per share Well, book value per share is of no use in this question, guys, because we want to get the value of the share or price of the share using two different models. So book value is actually making no sense. So leave it. Return on equity is 15%. Now, okay, return on equity is something that is giving me some more hint that this is turning out to be useful. So we have book value per share. It is useful because now we have the return on equity number. So 137.8 is the book value per share, and we have the return on equity to be 15%. So return on equity is 15%. Now, if the return on equity is 15%, which means we are investing, the company is earning 15% for its equity shareholders. Can you tell me how do we get the earnings per share? How do we get the earnings per share? Can I say it's going to be 15% of 137.8? So we get the EPS, right? EPS is 137.8 multiplied by 15%. So 20.67 is the EPS. 20.67 is the EPS. Then it follows a policy of retaining 60% of its earnings. 60% of its earnings. So can I say, what is the 60% number? What is the 60% number? P, correct. Retention ratio. Retention ratio is 0.6. We obviously call this retention ratio D. Retention ratio is D. We got the retention ratio. Now, of course, we'll need the growth rate. You know what? This return on equity is nothing but your R. So what will be the growth rate? What will be the growth rate number? How do we get the growth rate? This is simply B into R. So B is 0.6. This is multiplied by 0.15, or you can also call it as 15%. So that comes out to 0.6 into 15%. So the growth rate is 9%, guys, correct? Growth rate is 9%. Now let's apply the dividend growth model or Gordon model. So Gordon model, when we apply the Gordon model, we get the price which is equal to P0. P0 is going to be simply using the Gordon formula, which is this one. P0 is EPS 1 into 1 minus B upon K minus G. P0 is, EPS is what we know, is 20.67. So that multiplied by 1 minus 0.6, which is the retention ratio, upon K minus G. So K is given in the question. Yes, K is given. How much is the K, guys? Opportunity cost of capital. Cost of capital is 18%. You can say it is 0.18 minus growth rate of 0.09. So what's the price coming out to be? 20.67. The price coming out to be 20.67 multiplied by 0.4 divided by 0.09. It's 91.86 or 91.87. Is the price of the share as per which model, guys? Gordon model. As per Gordon model, we get the price as 91.87. Correct? Are we getting this price? The Gordon model? Now it's time for the other model, which is Walter model. Okay, so how do we get this Walter model? Walter model, what is the formula? I hope you remember the Walter model formula, guys. Walter model, we say P0 is D plus. So D plus, it's going to be E minus D, is earnings minus dividend, right? And this is further multiplied by what? Earning minus dividend multiplied by R upon K. We're going to multiply this R, then divide by K. And the whole expression is divided by K, right? So let's apply this formula. For this P0, what are the terms? Do we have D? Yes, we have the dividend value, which is, we need to compute the dividend value, right? Dividend is going to be earnings, which is defined as 20.67. Dividend is simply going to be earnings, EPS, multiplied by 1 minus B. So dividend is simply earnings per share of 20.67. This is multiplied with 1 minus 0.6. This comes out to be 20.67 into 0.4. Right? So dividend is 8.26, correct guys? Are we getting this dividend as 8.27? So 8.27, the amount of dividend. So we'll add to it EPS of 20.67 minus dividend of 8.27, right? And this multiplied by return on investment was 15% divided by KE of 18%, and this whole thing is divided by 18%, or you can say 0.18 also. So P0, how much is the price coming as per the Walter model, everyone? As per the Walter's model, what is the price? What is the price as per Walter model, everyone? Yeah. .27, let me just do it, 8.27 plus 20.67 minus 8.27 multiplied by 15% divided by 18%. This entire thing divided by 18%. Is it 103? 103.34? Correct, guys? 103.34 or 35? This 103.35 done? Are we done, everyone? Did we get the Walter model value? Yes. So we have done quite a few discussions about the valuations. We have done the constant dividend model, dividend growth model. We have discussed about the earnings-based approach, two-stage model. Three-stage model is pending, guys, which we will take up in the tomorrow's session. So I hope I was able to justify your Monday morning today, right? So I hope whatever we have discussed has been totally perfectly clear by you, right, guys?
Ashok ji,
Okay.
please open the session for the students. But Jagbandhu ji, the
Yes, sir.
query handle query has been all resolved or anything is pending? Just check the same.
I have answered him.
Okay, no problem.
Wait, there's only one question, so I've answered him anyways.
Okay, Abrikesh sir, please ask your query.
Yeah, Rakesh.
Hello.
Hello.
Yeah, Rakesh. Say.
Sir, I'm audible?
Yeah,
Yeah.
you're-
Sir, sir was telling that there will be tomorrow, there will be a class.
No.
No, no,
I am going
next
to
class.
correct it. It is a day after tomorrow.
No,
Okay.
not even sir, day after tomorrow. Sir, that is fine. It's a day after tomorrow. See, as per schedule on the portal, there won't be any class till 6th of October. So that's why I mean checking with you about. I mean, is there
Okay,
any
sir.
mistake on the schedule?
Just 1 second, sir. 1 second. Let me check.
Yeah,
It is on our screen. Okay, right now, just I check it.
Yeah.
Maybe I may also. This is. I think. Okay. There is some issue, sir. Don't worry. We will resolve within a half an hour. We will upload the revised schedule.
Sir, also I have a doubt.
Yeah.
Yeah.
Actually, I have a few questions related to the problems that I've solved, and I'm not sure if I got the right answer. So,
You can send it.
okay.
No
Okay.
problem. Okay, no
Okay,
problem.
thank
But
you.
yeah, just do one thing. Whenever you send the problem, na, you just make a proper don't take a screenshot. Rather, you make a PDF of the same.
Okay, sir.
Okay,
Okay, then.
because
Thank
generally
you.
what happens when you take a screenshot, na, when we get a printout of the same, it becomes
The
blur.
picture what it gets.
Yeah,
Okay,
it got a.
okay, sir.
So you just whatever the solution, you just write on a white sheet with a black ball pen. Okay, and just scan it.
Okay, sir. Thank you, sir.
Okay, students. Now there is one student has asked, sir, how to get the assignment. Okay, sir, just Jagbandhu ji, just stop sharing your screen, sir.
Yeah.
Now, student, first when you will go to BUS Knowledge Portal, it will be visible like that. Okay. Now here you have to go student login. Here you have to go into final. Okay. इनकी screen छोटी गई. Okay. Sounds. Okay. Then you will enter your registration number, and then you will enter your date of birth, a month, date, month, and year. Then you will say login. Okay. So once you log in, ultimately you will come into this kind of a there is this kind of a screen. Okay. Now here you can see download notes. Okay, now here the subject wise notes are all available. If you want to get it them sorted, just say advanced financial management. So all assignments of advanced financial management are there. Okay, student. So if you still have any doubt, you can contact me over the telephone. I will get you connected to the concerned person if you have any issue. Okay. And as in the today's class, there is one thing very beautiful that, as I told you in the beginning, sir has started with the basics of the financial management that you have covered at intermediate level as a part of cost of capital. So when I was just giving you the overview of the syllabus, this is the beauty of this chapter, that whatever you have learned in the CA intermediate. Okay. Now say there you have studied the cost of capital. Okay. So there was, you see that KE was, we have to calculate. KP we have to, now in today's class, if I talk about in today's context class, so KE we need to calculate at intermediate level. But in today's class, what you are saying, the KEE was available. Okay. We have to find out the justified price of the share. Okay, that is called intrinsic value. So this is the beauty of this topic, that whatever you have studied, in the intermediate level, we shall take its reverse. So, and sir has started a class with a very beautiful, you can say, developing a conceptual understanding like AP-GP series. Okay, how from the GP series we compute this formula. So, so generally what happens, there is always a saying that there are many formulas in the AFM paper. But my request to you, student, please note that there are hardly 2 or 3 formulas that you have to cram only. Other formulas are based on the logics. Okay, and then if you understand the logic, then you have to cram the formula. Okay, and as usual, if you have any query, you can contact me at you can send the at mobile app, or you can send contact me on this number, especially for the student who have an issue in downloading the assignment. So you will just contact me. I will transfer your phone to the concerned person. And for sending the any other query, you can send us at sfm-final@ICAI.in. So student, please get connected. And so far as the schedule is concerned, we will get it uploaded in a half an hour. So from there, please student, don't miss the class. Okay. Still you have any doubt, so you can contact us. Okay. Okay, student. With this, we come to the end of the session. Jagbandhuji, thank you very much for sparing your precious time and enlightening the student on this very interesting topic. Thank you. And student, thanks for your patient listening. Thank you. Have a nice day. One second. One student is saying, what's about the note? Student, please note that, of course, as sir has told, these questions are from your study material. So, of course, if possible, we shall develop some notes for you. Of course, it will helpful for your preparation. So, we will prepare some notes so that, and same will be uploaded in the due course. Thank you. Thank you, sir. Yes, sir. Session is over, sir. Okay.
Thank you, sir.
Thank you.